If you're in the home stretch, you're continuing to save for retirement, but you're hoping that you're able to retire in maybe about 10 years. Maybe you have some additional cash flow that you are looking to save. Maybe you're funding your 401k plan. Maybe you're putting money into a taxable investment account. There's additional ways that you can save even within your 401k plan that offer tax-free income later that a lot of people are not very familiar with, specifically because understanding your 401k plan rules isn't exactly an easy thing to do. I read summary plan descriptions for clients on a regular basis, and I help them figure out if their plan allows for what are called after-tax 401k contributions. And in today's video, I'm going to explain exactly how a after-tax contribution works inside of a 401k plan, how you can take advantage of it to generate tax-free income in retirement. Let's now walk through a case study so that we can see exactly how the after-tax contribution works inside of these 401k plans. So I'll say it's really important that you check your plan document. Not every 401k plan allows for this strategy. So you have to look specifically at yours to determine a few things. Number one, do they allow for after-tax contributions? Number two, which I'll explain later, do they allow for in-plan Roth conversions? Okay. And then number three, do they allow for in-service rollover distributions? Okay. So those are some important factors to consider with this. But let's walk through this case study and I'll explain those specifics in more details as I kind of walk through this. Okay, so let's meet Sarah. So Sarah is 50. Her salary is $300,000. She's fully funding her 401k. Let's just assume that it's pre-tax. She has some, tax planning issues that she wants to lower her taxable income. So she does pre-tax for her 401k contribution of $23,500. She also is 50, so she's eligible for the catch-up contribution of $7,500. So she's already deferring $31,000 to her 401k, which is pretty solid. In addition to that, her employer matches 3% of her compensation. So her employer also funds $9,000 per year into her 401k for a total contribution amount of $40,000 per year. Now, she has free cash flow. So she's looking for ways to save additional money. Maybe right now she's funding a taxable investment account. That's great. There are some, tax inefficiencies with taxable investment accounts, i.e. dividends and interest are taxable. Still a spectacular way to save. But her 401k plan allows for these after-tax contributions. So how does she go about implementing? First off, she's allowed an additional $37,500 because the limit for her IRS in 2025 is $77,500. So she's looking to save an additional $37,500. Maybe it's $1,000 a month that you're able to squeeze into your 401k plan. But in this case, she's allowed an additional $37,500. So we're going to kind of go with that. So step one, she modifies her contribution. So she goes onto her portal and checks the box that she wants to do after-tax contributions and sets it up so ultimately $37,500 is put into her 401k. She specifically selects after-tax contribution. Step number two, assuming her plan allows for this, she then sets it up so those contributions are immediately converted to a Roth. The benefit of the Roth is that you pay the tax on this money now, but it grows tax-free forever once the money is in. Step number three, ensure the funds are invested and just watch your money grow. Now that she has taken all these steps, which was increase her contribution amount to the after-tax bucket, $37,500, she set it up so those funds automatically convert to the Roth 401k, and she's ensuring that the funds that are ultimately in that Roth 401k match her investment objectives. So whether she's aggressive, conservative, etc., she sets that up accordingly. Now, a couple things I want to point out. Not every plan allows for these for step two, okay? So some plans allow the after-tax contributions, but they don't allow the conversion to the Roth 401k. So a couple things you could do. Number one, you could just leave the money in the after-tax account inside of your 401k. You will never pay tax on that $37,500 ever at any point, even when you take the money back out. But all the earnings on that $37,500 would be taxable when you go to take a retirement withdrawal. That is why step two is crucial, is that you get those funds into the Roth. Because the difference between the after-tax account and the Roth account is the earnings within the Roth are also going to be tax-free. So if your plan allows for the after-tax contributions, but does not allow for the conversion, you would want to consider an in-service rollover. So here's that exact scenario for Sarah, but instead of being able to convert the funds into the Roth 401k, she does an in-service rollover into a Roth IRA. So everything with step one is exactly the same. The change really occurs with step two. So instead of it being able to be converted into the Roth 401k, she reaches out to her plan administrator and does an in-service rollover or an in-service distribution. And she specifies that she wants to roll her after-tax contributions to a Roth IRA. So she's in essence doing the same thing as she was inside of the 401k, but instead the only difference is that those after-tax funds are going to go into a Roth IRA as long as the plan allows in-service distributions. The other caveat that you need to figure out. She'll experience the same exact tax benefits inside of that Roth IRA that she would experience inside of the 401k. So there are multiple steps to this type of strategy. You have to understand your plan document. You need to understand, obviously, your cash flow, and that additional funding, retirement funding, is one of your objectives. And then you have to execute on it. I have oftentimes walked clients through this on their 401k portal to ensure it's all structured correctly. And if they aren't allowed to do the in-service conversions, we would, at the end of the year, make a call to that 401k plan administrator and request a rollover of the after-tax contributions into their Roth IRA and accomplish it. So I usually walk them through this as opposed to somebody doing this on their own, because obviously there could be some hiccups along the way. But fortunately, I do this on a regular basis with my clients, and so it's a pretty smooth process. So let's see how this benefited Sarah in the long run. Let's fast forward 10 years. Assume that she continued to do this every single month. She made this contribution. Ends up being $3,125 every month. If each one of those contributions compounded at 7%, so 7% return on investment, at the end of 10 years, this would be an additional $540,890 of retirement savings that she has accumulated. And guess what? It's 100% tax free. She paid the tax on the front end when she made the contribution. That money now grows completely tax deferred. She retires. She takes out, say, $25,000 or some number as a part of her retirement income plan, and it's completely tax-free. You really need to review your plan documents. Understand whether or not this provision is embedded into your plan. Review your cash flow to determine if you can start to squeeze additional money into some sort of savings account. And then also ensure that you have this properly structured so that every time these contributions go into Roth, whether it's Roth 401k or Roth IRA, that money gets invested. So if you need assistance with reviewing your plan documents, any other financial planning strategies, please reach out to us for a consultation and see how we can assist you.